What's up, everyone? I am bringing you a massive red alert warning today because a brand new IRS rule change just went live, and according to latest surveys, over 85% of American seniors have absolutely no idea it exists. This isn't just a minor paperwork update. It's a fundamental shift in how the government treats your retirement savings, and if you miss the deadline for this hidden mandate, the IRS is authorized to seize up to 25% of your hard-earned money in penalties alone. We are talking about a specific provision buried deep within the Secure Act 2.0 and the recently passed One Big Beautiful Bill of 2025 that has officially reached its final implementation phase for 2026. This rule is a total game changer for anyone over the age of 50, and it's sending shockwaves through the financial planning world. Hit that subscribe button right now because the information I'm about to reveal is the difference between keeping your nest egg and handing a massive chunk of it back to the federal government, the $6,000 shadow deduction. First, let's talk about the unprecedented legal bombshell that most mainstream news outlets completely ignored. As of January 1st, 2026, the IRS has officially activated what experts are calling the senior bonus deduction. This isn't your standard inflation adjustment. Under the new tax laws, if you are 65 or older, you are now eligible for an additional $6,000 write-off on top of your standard deduction. For a married couple where both spouses are over 65, that is a staggering $12,000 shield against your taxable income. But here's the kicker, and the part that will make your blood boil. The IRS has designed this with a cliff phase-out. If your modified adjusted gross income, MAGI, crosses a specific threshold, $75,000 for singles or $150,000 for joint filers, that $6,000 bonus starts to vanish instantly. This creates what legal scholars call a tax dead zone. If you accidentally withdraw just $1,000 too much from your IRA this year, you could trigger a cascade that wipes out your entire $6,000 deduction, effectively costing you thousands in phantom taxes. The catch-up contribution. Ambush. But that's not even the most explosive part. We need to talk about the Roth mandate, the secret weapon the IRS is using to front-load tax revenue on the backs of seniors who are still working. For decades, if you were over 50, you could make catch-up contributions to your 401k or 403b to lower your tax bill. It was a classic win-win. But as of right now, if you earned more than $145,000 in the prior year, the IRS has outlawed pre-tax catch-up contributions. That's right. They have literally banned you from using that money to lower your tax bracket. You are now forced to put those catch-up funds into a Roth account. This means you pay the taxes now at your highest earning years, instead of later in retirement. Most seniors are going to look at their first paychecks of 2026 and wonder why their take-home pay has plummeted. It's not a mistake. It's the Roth mandate in full effect, and if your HR department hasn't warned you, you are already walking into a tax trap, the 0.003% danger zone. Why is this happening now? Because the government is looking at the trillions of dollars sitting in senior-held IRAs and 401ks, and they've realized they can't wait 20 years to tax it. By forcing these changes, they are essentially harvesting your retirement early. Statistics show that while only a small percentage of people are high earners, the way the IRS has indexed these rules means that inflation is pushing more middle-class seniors into these high-wage earner categories every single month. You might think you're safe, but with the 2026 cost of living adjustments, you are statistically more likely than ever to hit a tax trigger you never saw coming. And wait until you hear what they've done to the inheritance rules. If you are planning on leaving your IRA to your kids or grandkids, the IRS just fundamentally changed the timeline for how they have to pay taxes on that money, and it could lead to a 50% penalty if they don't follow a rule that was just finalized months ago. The 10-year inheritance nightmare. All right, if you thought the taxes on your own income were bad, wait until you see what the IRS has done to the money you plan to leave behind. This is the part of the new 2026 regulations that is going to devastate families who think they are protected by the old stretch IRA rules. For decades, if you left an IRA to your children or grandchildren, they could stretch those distributions over their entire lives. It was one of the greatest wealth-building tools in history. But the Secure Act 2.0 has officially slammed that door shut, and as of this year, the IRS is enforcing the 10-year rule with a vengeance. Here is the bombshell. Most non-spouse beneficiaries, meaning your adult children, must now completely empty that inherited account within 10 years, but it's worse than just a deadline. Under the newest 2026 clarifications, if you were already taking required minimum distributions, RMDs, when you passed away, your heirs cannot just wait until year 10 to take the money. They are now mandated to take annual distributions in years 1 through 9. If they miss even a single year, the IRS is waiting with a 25% excise tax penalty on the amount they should have withdrawn. They are literally forcing your children into higher tax brackets during their peak earning years, effectively shredding the generational wealth you spent a lifetime building. The super catch-up loophole. Now, let's talk about a secret weapon for those of you still in the workforce or consulting. The IRS just activated something called the super catch-up provision. This is one of the few wins in the new law, but it's tucked away in such a specific age bracket that almost nobody is talking about it. If you are between the ages of 60 and 63 in 2026, the government is allowing you to shove a massive amount of extra cash into your 401k or 403b. While the standard catch-up for those over 50 is $8,000 this year, if you fall in that 60 to 63 Goldilocks zone, your limit jumps to $11,250. That means you can contribute a total of $35,750 in a single year. But here is the catch, and it's a big one. This super catch-up is optional for employers. Your HR department isn't required to offer it. If you don't walk into their office and specifically ask if they've updated their plan to include the Secure 2.0 super limits, you are leaving thousands of dollars in tax advantage growth on the table. This is the IRS's way of saying, save as much as you can now, because they know they're going to get it back later through the new RMD age triggers. The RMD age confusion, born in 1959, we need to clear up the massive confusion surrounding required minimum distributions, RMDs, because the goalposts just moved again. If you were born between 1951 and 1959, your magic number is 73. That is the age you must start taking money out, whether you want to or not. However, there is a stealth trap for those born in 1960 or later. Your RMD age has officially been pushed to 75. While that sounds like a win, more time for your money to grow, it's actually a double-edged sword. By delaying your distributions until 75, your account balance will likely be much higher, which means your mandatory withdrawals will be massive. This can instantly kick you into the 32% or 35% tax bracket, and, here's the kicker, it can trigger the Medicare Part B surcharge, IRMA. Most seniors don't realize that a higher RMD doesn't just mean more income tax, it can actually triple your Medicare premiums overnight. The IRS isn't just taking your retirement. They are using your retirement to make you pay more for your health care. It is a circular tax system designed to drain the highest performing accounts. The charitable shield no one uses. If your blood is boiling yet, let me give you the secret strategy that the wealthiest 1% are using to bypass this entire system. It's called the Qualified Charitable Distribution, QCD. If you are 70, 12 or older, you can tell the IRS to stay away from up to $105,000 of your IRA money per year. Instead of taking the distribution and paying income tax on it, you send it directly to a 501c3 charity. This counts toward your RMD, but doesn't show up as income on your tax return. Why does this matter? Because by keeping that money off your return, you keep your adjusted gross income low, which protects your Social Security from being taxed and keeps your Medicare premiums at the base rate. It is the only legal trapdoor left in the tax code that allows you to fulfill your RMD without the IRS taking a single penny, but you have to do it before you take your regular distribution or the shield is useless. Alright, this is the final piece of the puzzle, and it is the most dangerous one for your monthly cash flow. We are talking about the Social Security tax torpedo. This isn't a new law, but the 2026 COLA, cost of living adjustment of 2.8%, has just turned it into a lethal financial trap for millions of seniors who were previously safe. Here is how it works. The IRS uses a specific formula called provisional income to decide if they can tax your Social Security. They take your adjusted gross income, add in any tax-exempt interest, and then add exactly 50% of your Social Security benefits. If that total is over $34,000 for singles or $44,000 for couples, up to 85% of your Social Security becomes taxable. But here is the torpedo effect. Because the 2026 COLA increase pushed your benefits higher, and your RMDs, required minimum distributions, are likely higher due to stock market growth, millions of seniors are crossing these thresholds for the first time. For every $1.2 of extra income you take from your IRA, you aren't just paying tax on that dollar, you are unlocking another $0.85 of Social Security to be taxed. This creates an effective tax rate of nearly 50% on your retirement withdrawals. You are literally being penalized for the raise the government gave you. The Medicare IRMA surcharge trap. If the tax torpedo wasn't enough, we have to talk about the 2026 Medicare Part B bombshell. The standard monthly premium just climbed from $185 to $202.90. While that is a 9.7% increase, the real danger is the income-related monthly adjustment amount, IRMAA. If your 2024 tax return, which the IRS is looking at right now to set your 2026 rates, shows an income even $1 over the threshold, your Medicare premium doesn't just go up a little, it jumps to the next tier. We are talking about premiums skyrocketing from $202 a month to over $600 a month per person. This is a cliff penalty. There is no prorating. If you are $1 over, you pay the full surcharge. Most seniors find out about this when they see their Social Security check actually shrink in January, despite the COLA increase. The IRS and Medicare are working in a loop to claw back your benefits before they even hit your bank account. The one big beautiful bill. Deadlines. Now, let's look at the calendar, because the clock is ticking on the one big beautiful bill, OBEBA provisions. This landmark legislation created the $6,000 senior bonus deduction we talked about in Part 1, but it is temporary. This shield is only scheduled to run through 2028. If you are planning to do a Roth conversion, which is the #1 way to kill the tax torpedo, you need to act before these temporary high-standard deductions expire. By converting your traditional IRA to a Roth now, you can use that new $6,000 or $12,000 for couples bonus deduction to offset the taxes on the conversion. You are essentially getting a tax-free pass to move money into a forever tax-free bucket, but if you wait until 2029, that bonus deduction vanishes and the cost of protecting your wealth will skyrocket. The 25% missed deadline penalty. Finally, the most urgent warning, April 1st, 2026. If you turned 73 in 2025, this is your required beginning date. You must take your first RMD by April 1st, 2026. But here is the trap. If you wait until April to take that first check, you still have to take your second RMD by December 31st, 2026. Taking 2 RMDs in a single tax year is the fastest way to trigger the tax torpedo, jump into a higher tax bracket, and hit the Medicare RMAA surcharge all at once. It is a triple threat to your finances. If you miss that April 1st deadline by even 1 day, the IRS will slap you with a 25% excise tax on the amount you failed to withdraw. They have reduced this from the old 50% penalty, but 25% is still a devastating blow to a fixed income. What this really means for you. This victory of information represents more than just tax savings. It's about control. The IRS is counting on you not knowing these birth year triggers or the 2026 deduction limits. They are counting on you being a passive retiree. By using the Qualified Charitable Distribution QCD to lower your AGI, claiming the senior bonus deduction correctly, and avoiding the April 1st double RMD trap, you can keep thousands of dollars that would otherwise be torpedoed by the system. The psychological impact of seeing your raise vanish into taxes is enough to ruin a retirement, but now you have the blueprint to fight back. This is absolutely critical news that I had to get to you immediately. The 2026 tax season is officially the most complex one for seniors in over a decade. Make sure you let me know in the comments. Did you know about the $6,000 bonus deduction, or are you hearing it here first? And don't forget to subscribe to stay ahead of the IRS before they get ahead of you. Stay vigilant, and I'll see you in the next one.